Question 1. An investment advisor representative, IAR, is determining a suitable asset allocation for a client. The client is 30 years old, has a high risk tolerance, and needs to save for retirement in 35 years. Which of the following asset allocations would generally be most appropriate for this client? A. 20% stocks, 60% bonds, 20% cash equivalents. B. 60% stocks, 30% bonds, 10% cash equivalents. C. 80% stocks, 15% bonds, 5% cash equivalents. D. 40% stocks, 40% bonds, 20% cash equivalents. Answer, C. 80% stocks, 15% bonds, 5% cash equivalents. Given the client's young age, 30, long time horizon, 35 years until retirement, and high risk tolerance, an aggressive asset allocation heavily weighted towards equities is generally most appropriate. Equities offer the greatest potential for long-term growth, which is suitable for someone with a significant time frame to recover from market fluctuations. While bonds and cash provide stability, a lower allocation to these assets allows for maximum capital appreciation over a very long investment horizon. This strategy aligns with the principle that younger investors with longer time horizons can afford to take on more risk for potentially higher returns. Question 2. Under the Uniform Securities Act, USA, which of the following individuals would most likely be exempt from registration as an investment advisor, IA? A. An individual who provides investment advice solely to insurance companies. B. A financial planner who advises individuals on their retirement portfolios for a fee. C. A person who publishes a general market newsletter that does not offer personalized advice. D. A broker-dealer whose investment advisory services are incidental to its brokerage business and receives no special compensation. Answer, A. An individual who provides investment advice solely to insurance companies. Under the Uniform Securities Act, USA, certain institutional clients are specifically excluded from the definition of a person to whom investment advice is given that would require IA registration. Insurance companies are one such example. While financial planners and general market newsletters might fall under the definition depending on the specifics, e.g., personalized advice for a fee, and broker-dealers may have an exclusion for incidental advice without special compensation, advising solely insurance companies is a direct statutory exclusion for an IA. This distinction is crucial for understanding who falls under state IA registration requirements. Question 3. A client approaches an IAR expressing concern about inflation eroding the purchasing power of their fixed income investments. The client's primary objective is capital preservation and income, but they want to mitigate inflation risk. Which of the following investments would be most suitable for addressing this specific concern? A. Long-term corporate bonds. B. Treasury inflation-protected securities, TIPS. C. High-yield municipal bonds. D. Money market instruments. Answer, B. Treasury inflation-protected securities, TIPS. Treasury inflation-protected securities, TIPS, are specifically designed to protect investors from inflation. Their principal value adjusts semi-annually based on changes in the Consumer Price Index, CPI, and the interest payments are then calculated on this adjusted principal. While other options like long-term corporate bonds or high-yield municipals offer income, they do not inherently adjust for inflation, making them susceptible to purchasing power erosion. Money market instruments offer liquidity and minimal risk but typically yield very little and do not protect against significant inflation. Therefore, TIPS are the most direct and effective tool for a client seeking to mitigate inflation risk while maintaining capital preservation and income. Question 4. An investment advisor, IA, has discretionary authority over a client's account. The IA decides to purchase shares of a newly issued IPO for the client. Which of the following statements is true regarding this action? A. The IA must obtain written consent from the client for each IPO transaction. B. The IA can purchase the IPO shares without client consent if the investment is suitable. C. IPO shares are generally restricted for purchase in discretionary accounts. D. The IA must notify the client verbally after the transaction is executed. Answer: A. The IA must obtain written consent from the client for each IPO transaction. While an investment advisor with discretionary authority can generally make trades without specific client approval for each transaction, the purchase of initial public offerings, IPOs, often requires specific written client consent. This is a common regulatory safeguard due to the speculative nature and potential conflicts of interest associated with IPOs. The general rule for discretionary accounts allows for purchases of suitable securities, but specific types of investments like IPOs, or principal transactions, frequently carry additional disclosure and consent requirements. Therefore, for IPOs, even with discretionary authority, the IA must obtain prior written consent from the client. Question 5. A client, aged 60, is planning to retire in 5 years. Their primary financial goal is to generate a stable income stream during retirement, with a secondary goal of moderate capital appreciation. They have a low to moderate risk tolerance. Which portfolio allocation would be most appropriate for this client? A. 70% equities, 20% fixed income, 10% alternatives. B. 25% equities, 65% fixed income, 10% cash equivalents. C. 45% equities, 45% fixed income, 10% cash equivalents. D. 50% equities, 30% fixed income, 20% alternatives. Answer: C. 45% equities, 45% fixed income, 10% cash equivalents. This client is nearing retirement and prioritizes stable income and capital preservation with moderate appreciation, indicating a need for a balanced approach. A portfolio with 45% equities and 45% fixed income strikes a reasonable balance. Equities can provide some capital appreciation and inflation protection, while fixed income offers stability and income. The 10% cash equivalents provide liquidity. An allocation heavily weighted towards equities, 70%, would be too aggressive for their nearing retirement age and risk tolerance, while a very high fixed income allocation, 65%, might not meet the moderate capital appreciation goal or provide sufficient inflation hedge. This balanced approach best suits their stated objectives and risk profile. Question 6. Which of the following would not be considered an investment advisor under the Investment Advisors Act of 1940? A. A financial planner who charges a flat annual fee for comprehensive financial plans that include investment recommendations. B. A pension consultant who provides specific advice on asset allocation for corporate retirement plans for compensation. C. An accountant who, as an incidental part of their practice, advises clients on the tax implications of certain investments but does not charge separately for investment advice. D. A firm that manages discretionary portfolios for high-net-worth individuals for a percentage of assets under management. Answer: C. An accountant who, as an incidental part of their practice, advises clients on the tax implications of certain investments but does not charge separately for investment advice. The ABC test, advice, business, compensation, defines an investment advisor. However, the Investment Advisors Act of 1940 provides specific exclusions. An accountant, or lawyer, teacher, engineer, who provides investment advice solely incidental to their primary professional practice and does not charge a separate fee for such advice is typically excluded. The other options clearly meet the ABC test, as they are in the business of providing specific investment advice for compensation. This exclusion allows professionals to offer related financial guidance without automatically becoming registered IAs, provided the advice is truly incidental and not separately compensated. Question 7. An investment advisor representative, IAR, is evaluating a client's existing portfolio. The client is a retiree who primarily relies on investment income. The IAR discovers a significant portion of the portfolio is invested in growth stocks with high price-to-earnings ratios and low dividend yields. This situation would most likely represent a violation of which ethical principle? A. Prudent investor rule. B. Full disclosure. C. Timeliness of trades. D. Suitability. Answer, D. Suitability. The situation described directly relates to the suitability of investments for the client's specific needs and objectives. A retiree primarily relying on income, with likely a lower risk tolerance, would typically find growth stocks with low dividend yields unsuitable, as these investments are geared towards capital appreciation rather than immediate income. The core principle of suitability mandates that IARs recommend investments that align with a client's financial situation, investment objectives, and risk tolerance. While the prudent investor rule is related, suitability specifically focuses on the match between the client and the investment. Full disclosure and timeliness of trades are important but not the primary issue here. Question 8. Under the Uniform Securities Act, USA, which of the following is considered a security? A. A fixed annuity contract. B. A whole life insurance policy. C. A variable annuity contract. D. A precious metal coin collection. Answer, C. A variable annuity contract. Under the Uniform Securities Act, USA, a security is broadly defined. Variable annuities are considered securities because their value fluctuates based on the performance of underlying investment options, and they carry investment risk assumed by the contract holder. In contrast, fixed annuities and whole life insurance policies offer guaranteed benefits and do not expose the contract holder to investment risk, thus they are generally not considered securities. A precious metal coin collection is a tangible asset and not typically classified as a security unless it's part of an investment contract. Understanding the definition of a security is fundamental for regulatory compliance and product classification. Question 9. Which of the following actions taken by an investment advisor would be considered a prohibited practice under the Investment Advisors Act of 1940 and the Uniform Securities Act? A. Sharing in the profits and losses of a client's account, provided the client gives written consent. B. Charging a performance-based fee to a qualified client with over $1 million under management. C. Exercising discretion in a client's account without obtaining written authorization. D. Engaging in soft dollar arrangements where research services are received in exchange for client commissions. Answer, C. Exercising discretion in a client's account without obtaining written authorization. Exercising discretion in a client's account without obtaining prior written authorization is a fundamental and serious prohibited practice. This violates the fiduciary duty of an investment advisor, as it allows the advisor to make investment decisions without the client's express approval of that authority. While sharing in profits and losses is generally prohibited, it may be permissible under specific, limited circumstances with certain qualified clients and written consent. Performance-based fees are allowed for qualified clients meeting specific asset or net worth thresholds. Soft dollar arrangements are permissible as long as they meet specific safe harbor provisions under Section 28(e) of the Securities Exchange Act of 1934, provided the services benefit the clients and are reasonable. The absence of written discretionary authority, however, is almost universally a violation. Question 10. A client is seeking an investment that provides tax-exempt income at the federal, state, and local levels. Which of the following investments would most likely meet this objective? A. U.S. Treasury bonds. B. Corporate bonds issued in their home state. C. General obligation bonds issued by a territory of the United States. D. Mortgage-backed securities. Answer: C. General obligation bonds issued by a territory of the United States. General obligation bonds issued by a territory of the United States, such as Puerto Rico or Guam, are typically triple tax exempt, meaning the interest income is exempt from federal, state, and local taxes for all investors. U.S. Treasury bonds are only exempt from state and local taxes, not federal. Corporate bonds are generally taxable at all levels. Mortgage-backed securities are typically fully taxable at all levels. Therefore, territorial bonds are the best fit for an investor seeking complete tax exemption on interest income. Question 11. Which of the following economic indicators is considered a lagging indicator? A. Stock market prices. B. Building permits. C. Corporate profits. D. New manufacturing orders. Answer: C. Corporate profits. Lagging indicators are economic data points that change after the economy has already begun to follow a particular trend. Corporate profits, while important, are typically reported after a period has concluded, reflecting past economic performance rather than predicting future trends. In contrast, stock market prices are generally considered a leading indicator, anticipating future economic activity, and building permits and new manufacturing orders are also leading indicators, as they signal future construction and production activity, respectively. Understanding the different types of economic indicators is crucial for economic analysis and investment strategy. Question 12. An investment advisor representative, IAR, has recently changed firms. Under the Uniform Securities Act, which of the following statements is true regarding the IAR's registration? A. Only the new firm must notify the administrator of the IAR's employment. B. Only the IAR must notify the administrator of their change of employment. C. Both the IAR and the former firm must notify the administrator promptly. D. Both the IAR and the new firm must notify the administrator promptly. Answer: D. Both the IAR and the new firm must notify the administrator promptly. Under the Uniform Securities Act, USA, when an investment advisor representative, IR, changes employment from one investment advisor firm to another, both the IAR and the new employing firm are responsible for promptly notifying the administrator. This dual notification ensures that the administrator is fully informed of the change in association and can update the registration records accurately. The former firm would also typically have a responsibility to terminate the IAR's registration with them. This process helps maintain proper oversight of registered individuals in the securities industry. Question 13. A client is 70 years old, retired, and requires a consistent income stream from their investments. They have expressed a desire to minimize principal risk while accepting a modest return. Which of the following investment types would be least suitable for this client? A. Short-term U.S. Treasury bonds. B. Diversified portfolio of investment-grade corporate bonds. C. Equity income funds focused on dividend-paying stocks. D. Real estate investment trusts, REITs. Answer: D. Real estate investment trusts, REITs. Real estate investment trusts, REITs, invest in real estate and often distribute a significant portion of their income to shareholders, but they are subject to market risk and interest rate risk, and their principal value can fluctuate significantly. For a retired client primarily seeking consistent income with minimized principal risk, REITs, being equity-like investments, would generally be considered less suitable due to their inherent price volatility and potential for principal loss. Short-term U.S. Treasury bonds offer the highest safety and minimal principal risk. Diversified investment-grade corporate bonds provide income with moderate risk. Equity income funds, while having equity risk, focus on stable dividends, which can be part of an income strategy for some retirees, but REITs typically carry more volatility than the other options presented, making them the least suitable for minimizing principal risk for this specific client. Question 14. Which of the following is a primary characteristic of a private placement offering under Regulation D? A. It is typically offered to a large number of accredited and non-accredited investors. B. It requires full registration with the SEC, similar to a public offering. C. It is generally exempt from SEC registration requirements, subject to specific conditions. D. It must be sold through a registered broker-dealer to all investors. Answer: C. It is generally exempt from SEC registration requirements, subject to specific conditions. Private placements under Regulation D of the Securities Act of 1933 are generally exempt from the full SEC registration requirements that apply to public offerings. This exemption is crucial for companies raising capital efficiently without the extensive process and cost of a public registration. The offering is typically made to a limited number of investors, often primarily accredited investors, and requires specific disclosures but not the full registration statement. While broker-dealers may be involved, the key characteristic is the exemption from registration, provided specific conditions regarding the number and sophistication of investors and the manner of offering are met. Question 15. An investment advisor, IA, charges a quarterly management fee based on a percentage of the client's assets under management. This type of fee arrangement is considered A. A commission-based fee. B. A performance-based fee. C. A wrap fee. D. An asset-based fee. Answer: D. An asset-based fee. A fee charged as a percentage of a client's assets under management, AUM, is known as an asset-based fee. This is a common and transparent fee structure for investment advisors, aligning the advisor's compensation with the value of the client's portfolio. Commission-based fees are paid per transaction and are typically associated with broker-dealers. Performance-based fees are contingent on the investment's return and are generally restricted to qualified clients. A wrap fee is a comprehensive fee that covers advisory services, brokerage, and administrative costs, but the underlying calculation is often asset-based. Therefore, asset-based fee is the most accurate description of the stated fee arrangement. Question 16. A client makes a large withdrawal from their individual retirement account, IRA, at age 55 due to an unforeseen medical emergency. Which of the following statements is true regarding this withdrawal? A. The entire withdrawal is subject to a 10% early withdrawal penalty and ordinary income tax. B. The withdrawal is subject to ordinary income tax but is exempt from the 10% early withdrawal penalty. C. The withdrawal is tax-free because it's for a medical emergency. D. The withdrawal is subject only to the 10% early withdrawal penalty, not ordinary income tax. Answer: B. The withdrawal is subject to ordinary income tax but is exempt from the 10% early withdrawal penalty. Withdrawals from an IRA before age 59.5 are generally subject to both ordinary income tax and a 10% early withdrawal penalty. However, there are several exceptions to the 10% penalty, and withdrawals for unreimbursed medical expenses exceeding a certain percentage of adjusted gross income are one such exception. The withdrawal itself is still considered taxable income. Therefore, for a qualified medical emergency, the withdrawal would be subject to ordinary income tax but exempt from the 10% early withdrawal penalty. This specific rule provides critical relief for individuals facing unexpected medical costs. Question 17. Under the Uniform Securities Act, an individual who represents an issuer in effecting transactions in that issuer's securities would generally be considered a broker-dealer, unless A. The individual is compensated solely by commission. B. The transactions involve publicly traded securities. C. The transactions are in certain exempt securities or exempt transactions. D. The individual is also registered as an investment advisor representative. Answer: C. The transactions are in certain exempt securities or exempt transactions. Under the Uniform Securities Act, USA, an individual representing an issuer in effecting transactions in that issuer's securities is typically excluded from the definition of a broker-dealer if the transactions are in certain exempt securities, e.g., U.S. government securities, municipal bonds, or are part of exempt transactions, e.g., private placements, transactions with existing employees of the issuer without commissions. This exclusion recognizes that issuers may directly sell their own exempt securities or conduct specific types of transactions without needing to register as a broker-dealer. The other options do not provide a general exemption from broker-dealer registration for an individual representing an issuer. Question 18. A client with a long-term investment horizon, 20+ years, and an aggressive risk tolerance is looking for an investment vehicle that provides professional management and diversification, primarily focused on capital appreciation. They prefer an investment that trades throughout the day at market-determined prices. Which of the following would be most suitable? A. Open-end mutual fund. B. Unit investment trust, UIT. C. Exchange-traded fund, ETF. D. Variable annuity. Answer: C. Exchange-traded fund, ETF. An exchange-traded fund, ETF, is most suitable for this client. ETFs offer professional management and diversification, trade throughout the day on exchanges at market-determined prices, and can be structured to focus on capital appreciation, e.g., growth ETFs. Open-end mutual funds offer similar benefits but typically trade only once a day at NAV, which doesn't meet the client's desire for intraday trading. Unit investment trusts, UITs, are typically unmanaged, fixed portfolios that terminate on a set date. Variable annuities offer tax-deferred growth and insurance features, but also carry surrender charges and often higher fees, making them less ideal if the primary goal is simply capital appreciation through a flexible, tradable vehicle. Question 19. An investment advisor representative, IAR, discovers that a client has an outstanding margin loan and is paying high interest rates. The IAR recommends selling existing fully paid securities in the client's taxable account to pay off the margin loan. This recommendation would be most appropriate if A. The client's primary objective is aggressive growth. B. The client has a low-risk tolerance and is concerned about debt. C. The client needs to generate a short-term capital gain. D. The market is expected to enter a prolonged bull run. Answer: B. The client has a low-risk tolerance and is concerned about debt. Paying off a high-interest margin loan is generally a prudent financial move, especially for clients with a low-risk tolerance or concerns about debt, as it reduces interest expenses and financial risk. While it might involve selling appreciated securities and incurring capital gains, the reduction in ongoing interest costs can be a significant benefit. Recommending such an action when the client is focused on aggressive growth or generating capital gains might be contradictory, as selling securities would reduce their market exposure or realize gains prematurely. Similarly, expecting a bull market might argue for maintaining leverage, making paying off the loan less appropriate. The most compelling reason is risk reduction and debt elimination for a risk-averse client. Question 20. Which of the following would not be considered custody of client funds or securities under the Uniform Securities Act, USA? A. The IA receiving client funds for investment purposes and depositing them into an IA-controlled account. B. The IA having full power of attorney over a client's brokerage account, allowing trade execution and fund transfers. C. The IA having direct access to client funds through a limited power of attorney to pay third-party expenses. D. The IA receiving third-party checks payable to the client, which are forwarded to the client within 3 business days. Answer, D. The IA receiving third-party checks payable to the client, which are forwarded to the client within 3 business days. Receiving third-party checks payable to the client and forwarding them within 3 business days, without endorsing them or depositing them into an IA-controlled account, is generally not considered custody under the Uniform Securities Act, USA. This is typically a safe harbor provision. In contrast, if an IA has actual possession of client funds, power of attorney to transfer funds, or direct access to client accounts, they are considered to have custody, which triggers significant additional regulatory requirements, e.g., qualified custodian, surprise audits. The key is whether the IA has the ability to misappropriate client assets. Forwarding a check quickly does not generally provide this ability. Question 21. An investment advisor representative, IR, recommends that a client with a moderate risk tolerance invest 50% of their portfolio in a single sector mutual fund. This recommendation is most likely a violation of the principle of A. Liquidity, B. Diversification, C. Risk-adjusted return, D. Market timing. Answer, B. Diversification. Investing 50% of a portfolio in a single sector mutual fund, especially for a client with only a moderate risk tolerance, represents a severe lack of diversification. Diversification is a fundamental investment principle designed to mitigate unsystematic risk by spreading investments across various asset classes, industries, or geographies. Concentrating such a large portion of a portfolio in one sector exposes the client to significant industry-specific risk, which is inappropriate for a moderate risk profile. While liquidity, risk-adjusted return, and market timing are important concepts, the most direct and egregious violation here is the failure to diversify adequately. Question 22. Which of the following statements about municipal general obligation, GO, bonds is true? A. They are typically backed by a specific project's revenue stream. B. They require voter approval because they are backed by the full faith and credit of the issuer's taxing power. C. They are considered riskier than municipal revenue bonds. D. Their interest income is always exempt from federal, state, and local taxes for all investors. Answer, B. They require voter approval because they are backed by the full faith and credit of the issuer's taxing power. Municipal general obligation, GO, bonds are backed by the full faith, credit, and taxing power of the issuing municipality. Because they rely on the issuer's general tax revenues, they often require voter approval to ensure public support for the use of taxing authority. This makes them generally less risky than revenue bonds, which are backed only by the revenue generated from a specific project. While municipal bond interest is often tax-exempt, the triple tax-exempt status depends on the issuer, e.g., in-state, and the investor's residency, and is not always universal. Therefore, voter approval due to their tax-backed nature is a key characteristic distinguishing GO bonds. Question 23. Under the Investment Advisors Act of 1940, an investment advisor, IA, is generally required to register with the SEC if they manage client assets totaling at least A. less than $25 million, B. $25 million, C. $100 million, D. $200 million. Answer, C. $100 million. Under the Investment Advisors Act of 1940, an investment advisor is generally required to register with the SEC as a federal covered investment advisor if they manage $100 million or more in client assets. Advisors managing less than $100 million typically register with their state administrator, unless an exemption or exception applies. This threshold is crucial for determining federal versus state registration jurisdiction. Question 24. What is the primary difference between a traditional IRA and a Roth IRA? AE. Traditional IRA contributions are always tax-deductible, Roth IRA contributions are never tax-deductible. B. Traditional IRA withdrawals in retirement are tax-free, Roth IRA withdrawals in retirement are taxable. C. Traditional IRA contributions are made with pre-tax dollars, Roth IRA contributions are made with after-tax dollars. D. Traditional IRA has no income limitations for contributions, Roth IRA has no income limitations for contributions. Answer: C. Traditional IRA contributions are made with pre-tax dollars, Roth IRA contributions are made with after-tax dollars. The primary difference between a traditional IRA and a Roth IRA lies in their tax treatment of contributions and withdrawals. Traditional IRA contributions are made with pre-tax dollars, or are tax-deductible, leading to tax-deferred growth and taxable withdrawals in retirement. Roth IRA contributions are made with after-tax dollars, meaning they are not tax-deductible, but qualified withdrawals in retirement are entirely tax-free. While there are income limitations for contributing directly to a Roth IRA, and traditional IRA contributions may or may not be deductible depending on other retirement plan coverage, the core distinction is the pre-tax versus after-tax nature of the contributions and the corresponding tax treatment of future withdrawals. Question 25. A client is concerned about the potential for significant market downturns and wishes to implement a strategy that limits downside risk while still participating in some upside potential. They have a moderate risk tolerance. Which option strategy would be most appropriate for this objective? A. Selling uncovered call options. B. Buying put options. C. Selling covered call options. D. Buying a protective put. Answer: D. Buying a protective put. Buying a protective put option is an appropriate strategy for a client who wants to limit downside risk on an existing long stock position while retaining upside potential. The put option acts like an insurance policy, providing a floor on the potential loss if the stock price falls below the put strike price. Selling uncovered call options is a very high-risk strategy with unlimited loss potential. Buying put options alone, without an underlying stock position, is a speculative bet on a market decline. Selling covered call options generates income but limits upside potential if the stock price rises significantly, which is not the primary goal of retaining upside while limiting downside. Therefore, a protective put directly addresses the client's objective. Question 26. Under the Uniform Securities Act, USA, which of the following is not required to be included in an investment advisor's brochure, Form ADV Part 2A? A. The educational background and business experience of advisory personnel. B. The advisor's method of computing performance-based fees, if applicable. C. A complete list of all individual client names and contact information. D. The types of services offered and the fees charged for those services. Answer: C. A complete list of all individual client names and contact information. An investment advisor's brochure, Form ADV Part 2A, is a disclosure document provided to clients that details the advisor's business practices, fees, services, disciplinary history, and conflicts of interest. It is designed to help prospective and existing clients make informed decisions about hiring or retaining the advisor. However, it specifically does not require the inclusion of individual client names and contact information, as this would be a breach of client confidentiality. The other options are all mandatory disclosures within the brochure. Understanding the contents of the brochure is critical for IAs and IARs to ensure compliance with disclosure requirements. Question 27. Which of the following statements regarding the capital asset pricing model, CAPM, is true? A. CAPM is used to calculate the expected return of an asset based solely on its unsystematic risk. B. CAPM states that the expected return of a security is equal to the risk-free rate plus a risk premium based on beta. C. CAPM assumes that investors are irrational and risk-seeking. D. CAPM does not account for market risk in its calculation of expected returns. Answer, B. CAPM states that the expected return of a security is equal to the risk-free rate plus a risk premium based on beta. The Capital Asset Pricing Model, CAPM, is a financial model that calculates the expected return of an asset or investment. It posits that the expected return is the sum of the risk-free rate and a risk premium, where the risk premium is determined by the asset's beta, a measure of systematic risk, multiplied by the market risk premium, the difference between the expected market return and the risk-free rate. CAPM explicitly accounts for systematic, market, risk, not unsystematic risk, which can be diversified away. It assumes rational, risk-averse investors and is a cornerstone of modern portfolio theory. Therefore, Statement B accurately describes the core principle of CAPM. Question 28. A client has an urgent need for liquidity within the next 6 months. Their primary objective is capital preservation, and they have a very low risk tolerance. Which of the following investments would be most suitable for this client? A. Growth Stock Mutual Fund. B. Long-term municipal bonds. C. Money Market Fund. D. Variable Annuity. Answer, C. Money Market Fund. For a client with an urgent need for liquidity within 6 months, a primary objective of capital preservation, and a very low risk tolerance, a money market fund is the most suitable option. Money market funds invest in short-term, highly liquid, and low-risk debt instruments, providing stable value and easy access to funds. Growth stock mutual funds are too volatile and do not guarantee capital preservation in the short term. Long-term municipal bonds carry interest rate risk and market risk, making their principal value fluctuate, which is unsuitable for short-term liquidity needs. Variable annuities are long-term investment vehicles with surrender charges and market risk, making them highly unsuitable for short-term liquidity and capital preservation. Question 29. Under the Uniform Securities Act, an individual who provides investment advice for compensation and also executes transactions for clients as an agent would be required to register as A. An investment advisor, IA. Only. B. A broker-dealer only. C. Both an investment advisor, IA. And an agent of a broker-dealer. D. An investment advisor representative, IAR, and an agent of a broker-dealer. Answer, D. An investment advisor representative, IAR, and an agent of a broker-dealer. An individual who provides investment advice for compensation is generally considered an investment advisor representative, IR, under the Uniform Securities Act, USA, and must register as such. If that same individual also effects securities transactions for clients as an agent, typically on behalf of a broker-dealer, they would also need to register as an agent of a broker-dealer. The roles of an IA/IAR, advising for a fee, and a broker-dealer/agent, affecting transactions for commissions, are distinct, and an individual performing both functions must hold both registrations. The employing firm would be registered as an IA and/or a broker-dealer, while the individual is the IAR and/or agent. Question 30. Which of the following financial metrics is used to evaluate a company's ability to pay its short-term obligations? A. Debt-to-equity ratio. B. Price-to-earnings, P/E, ratio. C. Current ratio. D. Return on equity, ROE. Answer, C. Current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay off its short-term liabilities with its current assets. It is calculated as current assets/current liabilities. A higher current ratio generally indicates better short-term financial health. The debt-to-equity ratio measures leverage, P/E ratio measures valuation, and return on equity measures profitability. Therefore, the current ratio is the direct and most appropriate metric for assessing short-term solvency. Question 31. An investment advisor, IA, has decided to switch clearing firms, which will affect all client accounts. Which of the following statements is true regarding the IA's obligations to its clients? A. The IA must obtain oral consent from all clients before transferring their accounts to the new clearing firm. B. The IA must notify clients of the change and obtain their written consent or negative consent, depending on the specifics, before transferring assets. C. The IA can unilaterally transfer client accounts to the new clearing firm without prior client notification if it is deemed in the client's best interest. D. The IA is only required to update its Form ADV filing, no direct client notification is necessary. Answer, B. The IA must notify clients of the change and obtain their written consent or negative consent, depending on the specifics, before transferring assets. When an investment advisor, IA, changes clearing firms, it constitutes a material change that affects client relationships and potentially the handling of their assets. Therefore, the IA must notify clients of this change and typically obtain their consent for the transfer of their accounts. This could be affirmative written consent or, in some cases, negative consent, where inaction is deemed consent, if explicitly permitted by regulatory guidelines and disclosed properly. Unilaterally transferring accounts without prior notification or updating only Form ADV would be a breach of fiduciary duty and disclosure requirements. Client consent ensures transparency and acknowledges the client's agreement to the new custodial arrangement. Question 32. A client inherited a large sum of money and wants to ensure the funds are invested responsibly for the long term, eventually to be passed on to their grandchildren. They are concerned about potential estate taxes. Which of the following would be the most appropriate vehicle for this objective? A. A Roth IRA. B. A revocable living trust. C. An irrevocable trust. D. A 529 college savings plan. Answer, C. An irrevocable trust. For a client seeking to invest responsibly for the long term, pass assets to grandchildren, and specifically mitigate estate taxes, an irrevocable trust is generally the most appropriate vehicle. Assets placed into an irrevocable trust are removed from the grantor's taxable estate, potentially reducing estate tax liability. A Roth IRA is for retirement savings and does not directly address estate tax planning for large sums. A revocable living trust allows the grantor to retain control and modify the trust, meaning the assets remain part of their taxable estate. A 529 plan is specifically for education savings, and while tax-advantaged, it's not the primary vehicle for general long-term wealth transfer and estate tax planning. Therefore, an irrevocable trust is the best solution for the stated goals. Question 33. Which of the following is an example of market risk? A. A company's stock price falling due to poor management decisions. B. An investor losing money because their bond issuer defaults on interest payments. C. A diversified portfolio's value declining due to a general economic recession. D. A specific industry's stocks underperforming due to new regulations impacting only that sector. Answer, C. A diversified portfolio's value declining due to a general economic recession. Market risk, also known as systematic risk, refers to the risk that an entire market or market segment will decline, thereby affecting most or all investments within that market, regardless of their individual characteristics. A general economic recession causes a broad market decline, illustrating market risk. Conversely, a company's stock price falling due to poor management, business risk, an issuer defaulting on bonds, credit risk, or a specific industry underperforming due to regulations, sector-specific risk, are examples of unsystematic risk. Unsystematic risk can be mitigated through diversification, but market risk cannot. Understanding this distinction is fundamental to portfolio management. Question 34. An investment advisor representative, IAR, is evaluating two different investments for a client with similar expected returns. Investment A has a standard deviation of 15%, while investment B has a standard deviation of 10%. Based solely on this information, which statement is true? A. Investment A has higher unsystematic risk than investment B. B. Investment B has lower volatility than investment A. C. Investment A is guaranteed to outperform investment B in a rising market. D. Standard deviation is not a relevant measure of risk for investment comparison. Answer: B. Investment B has lower volatility than investment A. Standard deviation is a statistical measure used to quantify the amount of variation or dispersion of a set of data values. In finance, it is a common measure of an investment's historical volatility or risk. A higher standard deviation indicates greater volatility and thus higher risk. Therefore, investment B, with a standard deviation of 10%, has lower volatility and lower total risk, compared to investment A, with a standard deviation of 15%. Standard deviation measures total risk, not just unsystematic risk, and it does not guarantee performance in specific market conditions. It is a very relevant measure for comparing investment risk. Question 35. Under the Uniform Securities Act, USA, which of the following actions by an investment advisor would generally not be considered a fraudulent practice? A. Failing to disclose all material facts regarding a conflict of interest. B. Engaging in churning by recommending excessive transactions to generate commissions. C. Making recommendations for securities in which the advisor has no beneficial interest, based on reasonable research. D. Spreading false rumors about a company to manipulate its stock price. Answer: C. Making recommendations for securities in which the advisor has no beneficial interest, based on reasonable research. Making recommendations for securities in which the advisor has no beneficial interest, provided these recommendations are based on reasonable research and are suitable for the client, is a standard and ethical practice for an investment advisor. In fact, having no beneficial interest can reduce potential conflicts of interest. The other options describe clear fraudulent or unethical practices, failing to disclose conflicts of interest, churning, excessive trading, and spreading false rumors, market manipulation. The core duty of an investment advisor is to provide unbiased, suitable advice based on due diligence, and making recommendations without a direct interest, assuming suitability, aligns with this duty.